Hello, in this video I'm going to talk about how to leave a larger after-tax inheritance to your children. Last week I worked with a client couple who did not realize that there is a big difference between leaving a brokerage account or a retirement work plan like a 401k to their children. The reason is in the after-tax value. This client couple will not run out of money in their lifetime. They both receive pensions, they have large investment account values, they've paid off their house, and they also own a rental property. Plus, most importantly, they live well within their means. So they're not going to run out of money, and they will leave an inheritance to their kids. The question is, how should they best do that? I say kids or children in this video, but when we're talking about this scenario, they're actually in their 50s or 60s. So not really kids anymore. My clients planned on taking their withdrawals from their brokerage accounts first, then their tax-deferred accounts. For them, as a couple, that would give the lowest taxes that they had to pay in their lifetime. What it would do, though, is leave a large account balance for their kids to deal with. And their kids are high earners. Since the Secure Act 2.0 was passed by Congress, non-spousal beneficiaries of inherited tax-deferred accounts like inherited IRAs, inherited 401ks, they have 10 years to withdraw everything that's in the account. Typically when someone inherits an account, they're in their 50s or 60s. And usually those 50s and 60s are the high earning years of someone's career. So someone usually is already making a good amount of money. Then they have 10 years to withdraw from this inherited account. And that money is just stacked on top of their current earnings. So they pay a very high amount of tax on their inheritance if they inherit an IRA or a 401k or other tax deferred account. For my clients, if we think about longer term strategies and we think about multi-generational wealth, then they should consider withdrawing from their tax deferred accounts first and passing the brokerage account on to their kids. Let's take a look at some numbers so you can see the difference. For this example, we're going to assume that they're going to pass a $1 million inheritance to each of their children. We're going to assume that the children are high earners and they are in the top half of the 24% bracket. For married filing jointly, we'll say they earn somewhere in the mid 300,000 range of taxable income. If they're single, that would be in the high 100,000, 150,000 or so. Now, the best way to withdraw from an inherited IRA is to split it evenly over the 10 years. I made another video about this, and I'll put a link to that video in the description. If the children are going to inherit $1 million, divided over 10 years means they should withdraw $100,000 in that first year. When they do withdraw the $100,000, that's added on top of their other incomes, and so it's going to bump them up from the 24% bracket into the 32% federal tax bracket. State taxes would be in addition to that percentage. If we do a bit of calculations, and if we assume that half is going to be taxed at 24% and the other half of the $100,000 is taxed at 32%, then total tax due would be $28,000 on the $100,000 withdrawal, which means they're only keeping $72,000 out of the $100,000. Now, instead of tax deferred accounts being inherited, what if they inherited $1 million in a brokerage account? Well, when they inherit it, they get a step up in basis, which means the cost basis resets not from what the parents paid for the stocks or the funds, but to what the value of those funds was on the day of their death. So this is a huge difference. That means that the children who inherited the money could immediately sell the $1 million worth of stocks in there and pay no taxes. That's right, no taxes, because they got to step up in the cost basis. Now, true, in reality, there's going to be a delay from when the parents died to when the kids actually have control of the account. Not only is the amount of after-tax money that they get to keep a big difference, but another big difference is the fact that they don't have to sell. If they inherit an IRA, they have to take the money out. And maybe they could transfer the actual stocks from their inherited IRA over to a brokerage account, but somehow they're going to have to pay that $28,000 tax bill. If they inherited a brokerage account, their options would be completely open. They wouldn't have to sell in order to pay taxes. They could leave that money invested if they wanted to. If they wanted to sell some shares, they could do that. All their options would be open. Big difference too, of course, is the actual tax rate. Ordinary income rates are higher for these people. We saw it's either 24 or 32%, whereas the capital gains bracket that they're in would be 15%. So a huge savings there if they're paying capital gains taxes versus ordinary income taxes on the withdrawal from a tax-deferred account. So with this strategy, it depends on a couple of things that made it perfect for this situation. One is the fact that the parents are wealthy. They're not going to run out of money. There's no risk of running out of money. So they have the luxury of thinking about the next generation. Also, they're willing to pay more taxes themselves in order to save their kids some money. Some people aren't willing to do that. The strategy is a long-term, multi-generational type of strategy. It's not a save money this year kind of strategy. I hope you found the video useful, and please consider leaving a comment. I love to read those. Also, if this is your first time on the channel, please consider subscribing. See you next time.